The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. I'd like to start off the show by offering condolences to Marty Zweig's family. Marty passed away 2 days ago at the age of 70. I knew him when he came into the business. He was a real pro, a real gentleman, a really nice fellow, never made any enemies, and certainly did a lot of great work. I don't know why he passed away, but put a little white light out for him. He's a really nice fellow, and I know he'll be missed by a lot of people. Also, I'd like to put in a good word for Steve Rhodes' webinar tonight. Folks, it's for his subscribers. It's free, so if you're thinking of subscribing to his letter, which has done incredibly well with his trades, the webinar is just well worth the money, and if you do the subscription, you're basically getting it for free. So it's a heck of a good thing. He really knows the material and presents it in a great way. Okay, I want to start out the show today by talking about something that we talked about last week and the week before that and the week before that, and that is how these commodities have been, lagging the market. I particularly put into Tiger TV this morning the long-term daily copper chart going back 2 years, and I highlighted the fact that the last time we had one of these rising wedge channels that came in at the 786 level. You can see it by looking at the yellow circle in Tiger TV back in August of 2011, and we had the same pattern forming just recently. And 4 days ago, as a matter of fact, when we were doing our last commodity show last Thursday, we were breaking down below that trend line for the first time. And the importance of that line, especially the bottom channel line, you have those three higher bottoms, and each one of them is coming in at a 618 or a 786 retracement. And you can see what happened to copper, over the last 2 days. Yesterday it was down about 6 or 7 cents, and today it's down another 3 cents. That's a total of about $2,500 per contract in a matter of a few days. So, copper is breaking down badly. And if you stop and think what's happened to stocks during this time, and stocks have gone basically straight up, as I posted in the very first chart that I put into Tiger TV today, is the fact that the commodities have been lagging very, very badly. Now, folks, our commodity runs on gross domestic products. Gross domestic products are formed by commodities: houses, cars, iPads, telephones, toasters, watches, glasses, calculators, everything. I mean, so all these are done by, different products, whether it's plastic or copper or crude oil, whatever it happens to be. And so these are not confirming that we're in a booming economy. We, at the second part of the show here, I'm going to share some work from Bob Farrell. Bob is a little older than me, and he's a little older than Arch Crawford because he got Arch started in the business, but he's a real pro, and he's got some really good pictures of, regressions in how the market moves in waves. I'm going to share that in the second part of the show, but I wanted to talk about the commodities here first because they're so very important, to so many people. And I think the next one that we should talk about is the gold and silver index, because we've been watching it for a very long time. I have to get it to fit the page here for a second because it's coming down so fast that I don't get the chance to change it. But anyway, we've been warning about this breakdown in the gold and silver index for quite some time. Once we broke below that 148 level, which was $10 ago, it was really telling us that there's something wrong. I mean, these are the gold and silver stocks that make gold and silver. They mine the gold and silver. And when you see the gold chart that we've been watching for quite some time, and believe me, I was very, very bullish when gold was at that 1632 level. 1627. You can remember, it hit that 61% retracement, and then we had the rally up. And so, but now all of these things are beginning to fade to the downside, and they're fading very, very badly. Gold should have held the 1590 level, and it has broken down far below that right now. And I'm going to post into Tiger TV, the fact that we are breaking. We're decimating this thing, folks. I mean, this is not good for the stock market. I don't care what the Dow's doing today. It could be up 50 points. It ain't going to be up 50 points for very long because these people are not making products based on what these commodities are. That's the bottom line. If they were, they'd be buying the commodities. That's the bottom line. Maybe they have them in stock. Maybe they bought them really cheap. Maybe play the devil's advocate. I don't know. But, boy, this surely looks like one of the wildest divergences that I've personally ever seen in all my years of looking at this stuff. And the only two patterns that are really going crazy are the Dow Jones Transportations, which is a very small index, and also the Russell 2000, which also is a very small index. Both of those have gone exponential, but the rest of the things have not, broken down. The NASDAQ went to the 786. But anyway, we want to get back to this gold and back to the silver because we're breaking down badly. We're almost at another support point down around 1572, but frankly, I don't think that's going to, last very long in the gold market. It still looks like it wants to go even further. Last week we talked about the silver market holding the 2950 level. We're now trading at least a bottom, at least $1 an ounce below the the 61% retracement, and so the next level coming in is another $1 lower, around $27.60 for the silver coming in at the 786. Remember, we have that triple bottom at the 2580 level that we hit in September of 2011, January of 2011, September 2010, January 2011. We hit it also in 2012 in July, and if we go below it this time, silver will be headed back, towards $16 an ounce. But the main thing that we have to look at, and believe me, this is not just gold, silver, copper, folks. This is getting we're having the same situation happening in crude oil. Crude oil had the big Gartley sell pattern of that $98 per barrel that we talked about on the commodity show last week on Thursday, and also I think we talked about it on last Wednesday also. But these are breaking down, and they're breaking down badly. And this is a sign that what happened in 2007. And the thing that I've always look at when I look at these things, and I see the news where the VIX index is at had its biggest drop since 1929. That in itself, when I hear 1929, I immediately want to think, what could be similar to what we have in 1929? Here's a really interesting tidbit of information that I got out of this little book that I have called Only Yesterday. And in 1929, do you know that there were over 2,000 automobile companies in the United States? I couldn't believe it, but they had a whole bunch of them listed, and many of these cars, were only produced maybe a dozen of them or so. But at that time, there were 2,000 automobile companies in the United States, and of course, we went into a real severe contraction between 29 and 38, and then the war in 1941, took us out of the Big Depression, along with a lot of programs that have since gone by the wayside. Now, someone has asked about the chart of Apple, and we are at a very, very critical spot in Apple right now, because for the first time in a long time, we are having three bottom patterns forming since the middle of January, and that's a month ago. So we've had three patterns coming in, higher bottoms this could be the first time where, Apple could actually hold. But if Apple goes below another $20 from where it is right now, we still believe we're going to see that $3.94 a share in Apple, possibly lower, but that's our original price that we're watching. So that's the one thing that we want to keep in mind as we look at these. But take a look at the commodities today, folks. They're getting hammered. I mean, it's not just the main things we look at, of course, are copper and crude oil and gold. Silver, not so much, but it's getting hammered too also. But those are the, copper, silver, and gold are in a lot of different things. And even lumber, even though we made a marginal new high earlier in the week, has also gotten, hit pretty hard too. So there's a lot of things telling us that, you've had something going on here that is very, very sinister. And we've already seen the big break that we had in the meat markets, with cattle and hogs, getting hit pretty bad. So when the commodities are coming down, that tells you that there's a lack of demand, and that lack of demand is mainly what GDP is all about, and GDP is our gross domestic product. So if they're not buying this stuff now or producing it, who's going to be buying it later? That's going to be the bottom line. Now, I wanted to share before we get to the break. If I can quickly get this chart up, I wanted to show the euro over the past several days because when the market's closed here in the United States, we have a whole bunch of things happening that where you don't think you can trade very much. But I'm going to put the euro up here. And over the last few days, going back about 10 days, and you'll be able to see that all of the swings that we had since February 11th, each of the rallies were almost exactly equal, and each of them came almost exactly to the 61% retracement of the previous high. So we've had lower tops all along and lower bottoms. So you're in a downtrend. So if you wanted to trade with the trend, is you wait till you see these equal rallies that they have, and then you're able to do it because the market, repeats over and over again. It doesn't repeat with perfection, but it does repeat with enough of perfection that you're able to, get within a reasonable entry point. And with the whole thing you want to do, is to be able to control your risk. One other question that someone brought up, and that is, when you hear about people having large orders in the market, to be buyers or sellers. If any of you folks have ever seen the video of Paul Tudor Jones called The Trader, we'll cover. We have to take a little break here. When we get back, we'll talk a little bit more about big orders and that the video by Paul Tudor Jones, The Trader. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. you take a hands-on approach to managing your investments. And whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, folks, we're back, and we were mentioning the tape, the video by Paul Tudor Jones called The Trader. It's available all across the Internet now. It was brought out in 1986, and as soon as it came out, Mr. Jones wanted it back, and so they tried to buy it back. It was sold for $50, and they tried to buy it back from me for $100. Well, I mean, I'd watched the tape once, and I thought it was very entertaining, but when they offered me $100 for something that I paid $50 for, I knew that it was worth a lot more than that. And so I kept my original tape, and I showed it to a lot of people over the years, my students that I worked with, just because it was so interesting. But in that tape, you know, he shows that how they put out false prices. In other words, someone wants to sell 1,000 Treasury bonds at 103.09. You know, they're trading at 07. Well, they're watching those bids and offers, and that's probably not a good, a lot for $1,000. As soon as they see a trade at 08, they take it off. The problem is, once in a while, the market, there will be a bidder that'll come in there and take it off. So when you see these things that come up, that someone's offering certain amounts, things that's really not going to happen. Another quote from that book, Only Yesterday, was very interesting because during the crash of in the J.P. Morgan era, I believe it was a crash of 98. It wasn't a crash of 29. It was, I believe it was 98. I'm not sure which one, but anyway, Morgan said that I will buy all the stock available in, I believe it was General Motors, at when it hits $50 a share. He said that's the bottom of General Motors. Well, General Motors hit $50 a share, and the next uptick was 49.78, and it never looked back. And then later on, Morgan said, I pulled the order because I didn't think it would make money. So just because someone says something like that, that doesn't mean it's true. The only thing that counts in this business, folks, and I'll say this till the end of time, and that is the price. If prices are going up, there's more buyers. If prices are going down, there's more sellers. That's the bottom line. Then nothing's, whether you got inside information or not, doesn't make any difference, And another thing that I really find interesting, I only got a few minutes here for the next break so I can get on my sandbox. When you see the things like Carl Icahn, getting on the tube, and he has this feud going with David Einhorn. I mean, a real professional. They don't get involved with stuff like that. You just forget it. You can't get involved with, getting involved fighting with a skunk. And you know what the terminology for that is. It just doesn't work. And, why would I guess they do it because they get their names on the television. I don't know. I happen to know, Mr. Icahn's first vice president was a first personal friend of mine 30 years ago when they were running TWA. He's still alive and well, retired down in Florida. And when I talked to him about this, he laughed and he said, that's very uncharacteristic of him. But he said in the last, 15 years, he's changed a lot, which we all do. But there's no reason to get involved just because someone has a different opinion than you do. I mean, I don't understand why, but who knows? I mean, a lot of people disagree with me, and rightfully so. They should. Okay, I want to talk just a second here about the large divergence that we're having, and that is the divergence between the Treasury bonds and the S&P. We've had tremendously low yields. Over the past 31 years, since 1981, 32 years now, and we've got stocks up near all-time record highs, and so everyone is, clamoring, to buy yield, to lock in these low yields, thinking that they'll never see high yields again, which I think that this is most probably, we will see that, eventually down the road. We're having, a minor rally in the Treasury bond market right now, and when we get back, from the break, that will be the first market that we cover. Will be the Treasury bond market, because I believe that we have one more good rally to possibly get us up anywhere between 5 and 7, T-bond points to get the yield up to, or down to that 270 again. And that's where I would really like to, to begin selling, the Treasury bonds, from the short side, because with this economy turning down, if these commodities are correct, then this economy is not nearly as strong as the stock market. Believe me, the stock market is not the economy, folks. The stock market is a market for stocks, and that's what it is. If you have any questions, it's 877-927-6648.
Just recently, on December 28th, Market Insight subscribers were advised to go along the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, folks, this is Larry Pesavento for TFNN. I will get on my soapbox one more time, and that is that personally I think the Internet is probably the most sinister thing ever invented by man. I know it's got a lot of good uses, but boy, there's a lot of stuff on there that is bad. And I know it's bad for children, it's bad for adults, it's bad for a lot of things, and it's hard to separate, the good from the evil. But boy, there's certain things that are just terrible. I understand today that the Apple computers were hit with a super sophisticated cyber attack, so I don't know. Let's get back to what the real fun stuff is, and that's the market. The next few charts that I'm going to put on the market are in the chat room for TFNN and all for Tiger TV come from Bob Farrell. Bob was with Merrill Lynch. He also brought Arch Crawford into the business in 1960, and Arch is my neighbor here, and he respects Bob very much. But anyway, what Bob is showing on this chart here is the S&P over the past 13 years, and it shows reversion to the means. In other words, each time that the stocks get more than 3 standard deviations away from normal prices, that there tends to be a very, very swift and abrupt and not lethal but extensive change in price. And if you'll take a look at this chart, very, very closely, because it's very interesting, because it brings into the same thing that we talk about with the patterns. And if you look at the pattern in 2000, you'll see that we had a double top and even a three-drive pattern in 2000, right before the market broke. That was in July. And then in 2007, in September, we had another three-drive pattern where you made, a slightly higher high going into the new high. And here we are now into our third part of the standard deviation, where we're making another three-drive pattern. And, of course, the three-drive pattern on the New York Stock Exchange Index is still at the 786. It's not anywhere near the new high. Now, it's not just a question of if this works. It's a question of when it's going to work. We don't know when the turn is going to come, if it does, but the probabilities are that it will, just because of that. All I'm trying to bring out to you today for your 401ks and stuff is, this is not the time to be greedy. This is the time to maybe, tighten your purse strings a little bit, book some profits, and maybe just stand on the sidelines for a while just to see what happens. When you've got vertical markets like you have in the VIX, not that VIX is vertical, but on a downward basis, but like you have in the Russell 2000 and you have in the transportation index, and both of those are very small indices. It doesn't take very much to move those. Those are not good things, because vertical markets end the same way that they go down vertical. We've seen this over the years that I've been doing this show now for 6 or 7 years. I mean, it happens all the time, whether it's silver or it's soybeans or it's corn or it's apple or whatever. I mean, they all end the same way. I mean, markets that go straight up have a tendency to come straight down. That's the bottom line of what you're looking at. So you've got to keep in mind that this is not the time to be, exceedingly bullish. Now, remember now that we have a VIX index that is at a level that is equal to 1929. Like I said at the beginning of the show, that itself would make me believe that that's where, we're looking at the level. When I started the show, I was sighing a little bit because someone asked me a question in the Tiger's Den. A private question is where I thought when I thought the stock market would top, and I was gonna. The reason why I was thinking is that I could give it. I should say daily or someday in the future or something like that, because I thought it was going to top on February 5th. Now, the market hasn't gone up very much in the New York Stock Exchange Index since February 5th, or the NASDAQ, but unfortunately the transportations has gone higher, the Dow has gone higher, the S&P has gone higher, and so has the Russell. So, we're having a lot of divergence here, but we'll just have to wait and see. The main thing that I'm trying to give you today on today's report, my show, is that, and we're going to really cover this tomorrow in the commodities. We're going to go into all of them and let you look at, each of them to see, what's happening to some of these commodities, because they're telling us that we are far from a booming economy in these commodities, because it's just it's been a very, 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 very tough road to go on the long side. I mean, and I was really bullish on gold at 1627, and of course when we got to the 61% retracement at 1695, we were cautious then, and since that time, we've been in a really really big correction in gold, and we're continuing. To me, the gold looks like we're heading towards 1372. That would be a very, very long-term ABCD move in gold that will, eventually get there, because we're only $200 away now, and $200 in gold is not very much anymore. We could bounce anywhere in here because we're close to the 786 within $1 in silver, but right now you don't need to buy anything. You just wait and see what happens. The next chart also comes from Bob Farrell, and it shows the S&P 500 index along with the recessions. What he's doing is he's using Robert Shiller's real estate price data as far as determining recessions, which are shown by the little gray boxes, and then the S&P 500 in real time, and then it shows the difference in the bull and bear markets that we've had in time, and you'll notice that he's going back to 1871, folks. So this is a long-term long-term charts. It just shows you that the major swings in these cycles have, fear and greed. That's really what you're looking at. If you remember how bad things were in 2009 when, Paulson was telling everybody if we don't get $770 billion, all the banks are going to fail. And that's where we got the book that Andrew Ross Sorkin wrote called Too Big to Fail. And that was a total crock of baloney, as we now know, because the banks weren't failing. All they were doing was they needed more capital, and the only place they could get it was from the government. Had the government not given it to them, some of these banks, I'm sure, would have failed, like Bank of America and Citicorp. And for me, Citicorp has already failed because that stock is down 95% from its high. It's gone nowhere, and it's reverse split. I mean, if that's not failure, I don't know what is. And, the CEO only took a $1 per year salary, and frankly, he was overpaid at that, in my opinion. But that's just my opinion, and I won't verse it, anymore. But that's what we want to keep an eye on. Now, we need to get back to some of the other things that are happening in the economy, and some of the things that I think will, give us a good idea of where we are. Now, one of the things that I watch as far as the Dow divergence is the Dow utilities. And all we've done in the Dow utilities, since that November low, is to make a perfect ABCD Gartley pattern that stopped exactly at the 61% of the August high. And remember, the Dow, the S&P went above those highs, and the NASDAQ went to the 786 of those highs, and the New York Stock Exchange Index also took out those highs. So this is a major divergence between the Dow, the transports, and the utilities. So that's one factor, that needs to be looked at as far as I can see. And the other one that I think is important from a technical basis, and that is on the NASDAQ. We had a perfect head and shoulders pattern formed, and it was actually as good as it can get. I mean, the time was correct, and the shoulder to the head was 127. The head to the shoulder was 786. The numbers, fit the sequences perfectly. And here again, we have this, massive divergence that, that is occurring. Whether this continues to be a factor or not, we're going to have to, just wait and see. But right now, this pattern is certainly, we would have to get the NASDAQ up about 30 or 40 points for this head and shoulders, to be negated. But right now, it really is, quite a bit of a different story. Now, I want to go back for a second and look at some really long-term charts here, because I think they're very important. When you're looking at these from a investment standpoint, and as you can see, this will be the New York Stock Exchange Index. And what I've done is I have overlaid the Dow Jones chart on top of the New York Stock Exchange Index, so you can see, that the New York Stock Exchange Index has been lagging behind the Dow Dow being only 30 stocks, and of course they're not cap weighted, they're price weighted. In other words, the price of IBM has a greater weight than Hewlett Packard or Microsoft. So these are things that are I think very important. But we're making a 786 retracement almost to the exact tick in the New York Stock Exchange Index, which is the best of all of the indices to look at. So just be careful up in here. That's really what this is trying to tell you, because you have major divergences. The Dow did take out the high, I believe, of 2007 by just a little bit. If not, it was a double top or potential double top. So we'll see if that is going to, be the case. But these patterns are not telling us that we are in the, the beginning stage of another, big bull market, because that's not what's really happening. So we have to, keep that in mind. Also, on an international basis, we've had this tremendous move in the Japanese yen. that's caused the Japanese stock market to move, and it also has, had a tremendous move up, and we were talking about that in 2011 and also in 2012, the fact that we were having higher bottoms all the time in the Nikkei. And whenever you see that in any market, when you have higher bottoms or lower tops, this is the definition of a trend. And if people are buying the higher bottoms, you're in an uptrend. If they're selling the higher tops, you're in a downtrend. And that is the only way you can define trend, because if someone asks you what the trend was in gold, you'd say, oh, the long-term trend would be good, because it's still bullish. But the short-term trend is certainly down. Now, the chart that I'm going to put up next is the one that we looked at last week, which was the gold weekly chart, and it gives you that price objective that we could be looking at, which is around this $13.86 per ounce. That's the very large ABCD going back over a year and a half, and we could very easily get to that point. We got down below the 1580 level today, so that is only $200, and we've dropped $200 from 1804 to 1604 in a matter of just a few months. And so in a few months we could very easily, or even sooner, be down to this 1386 level. So these are the things that we're keeping in mind for where these markets should hold. But we broke below the 786 today in the gold on the weekly. At that 1580 level, and we'll see how it acts over the next few days. And it gives a lot of short-term buying opportunities in the gold. There's no question that you get some really nice ones, to look at if you're watching the 30-minute charts. They certainly give you a lot of great, opportunities. The next of the long-term charts that I wanted to show was the crude oil chart, because we've been in a downtrend in crude oil ever since April of 2011, and we had almost a double top in February of 2012, and we just completed a bearish Gartley at that $98 per barrel level, and we've dropped dramatically. We actually dropped $2 a barrel today in crude oil in a matter of a few hours. And that's probably the selling that we were having in the gold and the silver and the crude oil and all the commodities were probably hedge funds because they all head for the door at the same time. They were probably trying to get to that door at the same time, and they shut the door, and the grease on that door when you're trying to get out doesn't keep it open very long. So you've got to be selling things when they're going up and taking your profits, and on the same token, you want to be buying things when people really don't want them, because that's the best price that you can get, and it's also the price where you have the least amount of risk. So, that's the real secret to trying to, to be successful, is you want to buy things when they're cheap and sell things when they're dear. I believe that Mark Mobius, who runs the Templeton funds, it comes from John Templeton, of course, Templeton said the best time to buy is when there's blood in the streets. And that's probably true, because that is when the sentiment has got to be the absolute worst of anything that you really want to look at. Now, the next chart, I want to get back to bonds here for just a second, because I'm going to put the bonds and notes, of course, but I'm going to put the notes up because going back to 2007, we've had some pretty strong cycles that have been in the market, and they're bottoming now, and that's why we have a potential for one more rally up in the notes and bonds, because we topped way back there in July of 2012, and yet the interest rates have not come down very far. They've come down a little bit, but have gone up a little bit, but they haven't really done very much at all. So we still have a potential for one more really good rally in the notes and bonds. That's what my assumption is, looking at these cycles. But the question is, if we do get it, what is it going to mean, and how are we going to be able to handle it? So you just have to wait until that occurs, and then you'll be able to be better. We got to take a little break here, and when we get back, we're going to go to the U.S. dollar index and the euro. 877 927-6648.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Folks, and we're going to give a little accolade to our fearless leader, Tom O'Brien, about the King Dollar, and we posted it into the Tiger TV, and as you can see, it's been a very beautifully symmetrical and harmonic chart, and by that it means the patterns have been fitting so very, very nicely. The trend is still up. All the dollar index needs to do is get a little above the 180, above the 83 level, and it should be, off to the races for another move. Because the dollar index is 53% of the euro, I put into the Tiger TV the Euro weekly chart that shows that we completed a perfect 61% retracement up at that 138 level. And now we are in the midst of our first correction. We're down, several days in this correction. There's a small amount of support at the 133 level in the euro, but below that, you'd be looking at the 129 level. That's most probably, because we've had some, major moves here, and that certainly tells us that we are in a spot where you could get either or. Whatever. I mean, it could go either way, of course. Now, the next one that is very, very close to, our type of economy is the Australian dollar. And if you ever believe in the numbers of the Fibonacci summation sequence, you have to look at this Australian dollar on a daily basis. And you'll see that it tested the exact 786 at the 106 level. It tested it 4 times over a period of 7 months to the exact price, and each time the moves were well over $5,000, and now we've come down to this 102.50 level. And if we get below the 102.50 level in the Australian dollar, you'll be breaking the 786 of the low from last October, and that means that you're going to be in a pretty significant downtrend, which will certainly not be beneficial to the Australian economy, because that means their prices are being marked down with their currencies, which is not usually a good thing. It's okay if you live in Australia, but if you buy things from outside, then it's certainly a lot different. Now, the one that has been ruling the roost, and here again, Tom O'Brien was one of the first people to talk about this down at the 75 level. We became bullish around the 76 level when we made the little butterfly pattern and the 786 retracement in September. And, of course, we had, the vertical move. We're only about a point or so away from the long-term 786, going back, 3.5 years in the dollar versus the yen at 96. But the thing to keep in mind with this, folks, is that this this started at 281, and it's at 94 right now. Live every day in an attitude of gratitude, and may God bless, and try to get into Steve Rhodes' show tonight. It'll be worth the price of admission.